Welcome to the second of our Investment Insight series, Magellan Minutes. My name is Jennifer Herbert, Key Account Manager at Magellan, and today I'll be talking with one of Magellan's infrastructure portfolio managers, Ofer Karliner, about our latest views on the infrastructure sector. Thanks for joining us, Ofer.
Thanks, Jen.
Ofer, the airports were absolutely slammed during COVID, with passenger numbers down as much as 99% at one point. Historically, we've seen passenger numbers revert back to trend quite quickly after crises. We saw this after the GFC and even after 9/11. How and why is this time different? When will airports get interesting again? And do we see opportunity now that the vaccine is on its way?
You're right. Historically, what we've seen is a recovery in sort of 2 to 3 years back to the historic trend line of growth. This time, we think it's a little bit different. So the main thing we're concerned about is the economic impacts of COVID. Not just the size of them, but the fact that they're global. In fact, all markets are being hurt by this. And as a consequence, we expect some of the demand to be permanently lost. Additionally, we expect there's a structural shift in the market. So business travel is not all going to come back. We don't know the scale yet, and there's a lot of speculation as to how much business travel will be replaced by video conferencing, but certainly some of those trips will be lost. We're being what we think is relatively conservative and assuming a sort of a 10% decline in traffic relative to the prior trend going forward. And in terms of when an airport's going to get interesting again, for us, they are interesting. That's a problem. We like them boring. We prefer them boring. What we're seeing at the moment is quite a wide range of dispersion in likely outcomes. Now, that has been narrowed by the vaccine. They all look very cheap, 2-3 months ago prior to the announcement of vaccine, but our confidence around that was low. Certainly, that confidence interval has been tightened significantly. But there's still some uncertainty around vaccine rollout and how traffic comes back. So what we've done is try to position ourselves in those stocks that we have the most confidence in. So we have a view that traffic will come back first for VFR, visiting friends and relatives, then leisure travel, and finally business. And also domestic and regional will come back prior to long-haul international. There's a few reasons for that. Obviously, you haven't seen your family for a while, you're going to hop on a plane quickly to go and see them. There's pent-up demand for leisure travel for people who've been cooped up at home for the better part of a year now. But business travel will come back more slowly, partly because of the video conferencing, but also because companies' balance sheets are going to be tighter. And companies have liability for their employees, so they're going to be more cautious about sending people out on planes and to travel to foreign markets in particular. In terms of travel, domestic travel's come back already quite strongly in markets where COVID's been held under control. So New Zealand is sort of down 35%. China is in fact up in some cases for domestic travel. So confidence is returning quite quickly. Regional, we're thinking things like travel bubbles, for example, or regional Europe. When that opened up around August, we saw traffic start to come back quite quickly. Again, finally, long-haul international will be the slowest part to come back. So our biggest position here is AINA. AINA is 91% domestic and regional. It has about 19% business travel, which is low by comparison to its listed peers. So we're positioning ourselves for those stocks where we have the most confidence in the recovery.
And toll roads also got hit, albeit not so severely. They've seemed to recover quite well. So what is the outlook for toll roads from here? Do you think we can expect government investment to support infrastructure as they try to stimulate the economy and support the recovery?
Yeah, you're right. Toll roads were down, intercity toll roads were down around 80%, urban toll roads down around 50 to 60 at the peak of the crisis. And what we've seen is they've recovered quite quickly. So in France, for example, there were some weeks in summer where traffic on the toll roads was actually ahead of where it was last year. There's a few reasons for that. Part of that is the ability to travel on planes, but we saw traffic recover quite quickly. We've seen something similar in Australia in terms of transurban. So what's driving that, first of all, is particularly for urban roads, a lot of these trips are not discretionary. So as long as you're getting on with your daily life, you're traveling to take your kids to school or to go to the shops, etc., you're taking these trips. So we expect, again, travel to return quite quickly as things normalise. The key risks here for both urban and interurban are around economics, as in if you have a sustained recession, we lose some trips as people are unemployed, as there's less freight on the roads, etc. The other thing to think about, particularly for urban roads, is around the work from home dynamic. There's been a lot of speculation as to how big an impact this will actually be. But to put it in context, even for Transurban, which is all urban roads, they have less than 20% of their traffic is commuter traffic. So certainly there'll be an impact. We've seen consultant reports which sort of speculate, depending on the developed market, between 18 and 27% of jobs can be done at home 3 days a week. Even then, not everyone will be allowed to work from home, even if they can. So again, there'll be an impact. How big that impact is a bit up in the air, but certainly those are the risk factors going forward. Offsetting that in the short term a little bit is people transferring off public transport. So we've seen across the world that people are more reluctant to get on trains and buses, etc., for health reasons primarily. So there are a number of factors at play, but ultimately we think demand will be impacted a little bit, but it's largely in the price. Now, the governments certainly need to stimulate the economy, and they also need to realise cash. So first of all, we've seen in a number of markets, the government's looking to get toll road companies to make investments. So France is the clearest one of this, where they've done it time and time again. They've actually, government has allowed material capex on the roads, and they get compensated by concession extensions. And those negotiations are ongoing now at the moment as well. What we expect to see as well is governments which are now cash strapped, and government debt levels have skyrocketed this year, to actually look to sell some of these assets to the private market to try and get down their debt levels. So there's certainly opportunities we expect to come loose over the next couple of years.
So let's move on to renewable energy, which is a hot topic right now. In the utility space, we focus on transmission and distribution, and we do have some exposure to regulated generation. So how do we think about the opportunity from renewables developing?
Yeah, we obviously don't invest in merchant generation, or the companies that primarily focus on merchant generation. We prefer regulated. So the big opportunities here, firstly, in transmission and distribution, are hooking up these solar farms and wind farms to the grid. So there's a material capex opportunity there. But by far the biggest opportunity is what we have integrated utilities, so they're regulated from generation all the way to the customer. And for those guys, the opportunity is really significant. So they're retiring old coal plants, legacy plants, etc., that are largely depreciated. So there's no capital left in them, or very little capital left in them, and they have a high operating cost. Now, the way utilities work is operating costs, operations and maintenance are a direct pass through the bills. So when you retire an old legacy plant and you replace it with capital expenditure, so a wind farm or a solar farm, you actually get to earn a return on that capital invested. The big constraint here is around customer bills. So you don't want customer bills to really take off. Our analysis shows roughly 10 to 11, for every dollar you save on operations and maintenance, you get to spend about $10 or $11 on capital expenditure without really affecting customer bills. There's a really big opportunity here to benefit from the transition from legacy power generation to renewables.
Finally, Ofer, what is your outlook for the infrastructure sector, and where do you see opportunities as we move into what will hopefully be quite a different year in 2021?
So the key opportunities here around those that will benefit from the narrowing of uncertainty around COVID. We expect sort of a slow grind towards the end of next year towards normality, particularly in developed markets. And I've talked about companies like AENA, which will benefit from that transition and removal of the uncertainty. By far, the biggest opportunity we see at the moment is in the utility space. So utilities, again, the ones we cover have really not seen much of an earnings impact at all from COVID. Most of them have affirmed guidance or confirmed that any losses they've suffered can be recovered in future years. Interest rates have come down, yet the cash flows have remained stable. Normally in that environment, we'd expect utilities to do really well, but they've actually performed pretty poorly this year in a relative sense. So they're down around 3% to the end of November. That's a surprise, and they're looking very, very cheap to us. And we think that's really the big opportunity for 2021 as those stocks normalise. And you can see that in the way we've positioned our portfolio through the year.
Ofer, thank you so much for sharing your insights with us today. And thank you for watching. If you have any questions, please do not hesitate to contact one of the Magellan team and feel free to share this update with clients or colleagues as you see fit. Take care and stay safe.